Thank you so much for tuning in to Exit Ready. Hope you enjoyed today's episode. We're going to unpack ways for you to make your company more valuable so that when you get ready to exit, you can get the most money possible. Now to the show. Well, Matthias, it is the first time I've spoken to you since you've become a newly minted father, so congratulations on that, man.
Appreciate it, Ryan. It's good to speak with you again. It's been a fun last couple of weeks here, so definitely different for sure.
Yeah, those first few weeks are definitely a roller coaster of emotion. So hope you're getting some sleep, but probably not. But good news is it gets better as time goes on, so you will get some more. So
Hey, kind of like Texas Tech football, right? So
hey,
just
whoa, whoa,
coming
whoa,
into
whoa, 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 whoa! That's gotta be nice. That's gotta be nice.
no, you guys have gotten better, but no,
Oh,
yeah, definitely.
I thought you meant rest because
No,
we got knocked out. I thought you meant we get
yeah,
a lot of rest. So yeah.
no, definitely appreciate knowing there's a light at the end of the tunnel. It's the feedings and the diaper changings. It's interesting how baby can go from being very peaceful and calm and cool as a
Mm-hmm.
cucumber to
Mm-hmm.
like all hell is breaking loose.
Mm-hmm.
So
Mm-hmm. Oh yeah, it's wild. It's wild. Okay, well let's get into it. So give everyone a quick background if they don't know who you are, what you do, and where you fit into this space, and then we'll hop into it.
yeah, so I own a firm, Ryan, called Pioneer Capital Advisors. So we're a acquisition financing and loan brokerage firm. Historically speaking, mostly focused on SBA financing. More recently, we've actually started a vertical for independent sponsor financing. Speaking from the SBA side specifically, we started back about 4 years ago, so in May of 2022, and we're currently comprised of a team of 8 people as of the time of this podcast. So it's myself, my chief operating officer, Valerie, Valerie Stash. So she has about 10 and a half years of working in the
Nice.
SBA space, worked at some of the top SBA banks, similar to myself. And then we have 2 sales guys, Raphael and Alan, a head of independent sponsor financing, Pablo, a head of closing operations, Andrea Prada. And then we have 2 analysts currently on the SBA side, Fernanda and Amari. I think that's it, but we're working to add 3 more roles. And so basically, kind of what we solve for, Ryan, is if you're a business buyer, let's just say yourself, for example, based in Texas, you want to buy a company, let's call it an HVAC or distribution business, $3 million top line purchase price, 1.3 debt service coverage, 70% bank financing. The question is, where do you go to get the financing for that deal? How do you find that subset of lenders as quickly and efficiently as possible? How do you really present your background in combination with the business in the most polished way? Because with lots of these banks, you kind of get one pitch at convincing them to like the deal, especially when there are credit or underwriting people involved. And so we basically help buyers position themselves in front of the right banks for their deal to remove as much friction as possible from the financing process. And so, kind of adjacent comment to that is a lot of people in this space, they will basically make the introduction to the lender and then they can't take a back seat. And there's nothing wrong with that. That's just the model of many firms. We're a lot more in the trenches, kind of for the whole life cycle of the deal. So it kind of starts with whoever the salesperson is on my team, either myself, Raphael, Ellen, or Andrew, who's moving the sales. And then it goes to the analyst who's putting the lender deck together. And then from there, the moment the deal goes into underwriting, it's my chief operating officer, Valerie, in conjunction with our closing specialists, working kind of hand in glove alongside the client to traverse any obstacles that may come up, whether it's the bank asking for something that could really be pushed to closing, documentation needed to get the SBA PLP approval, trying to negotiate a waiver of a lease agreement. Maybe the bank is asking for a 10-year lease on a business that's not location dependent, things like that. So, and then the magic kind of to it as well is on the SBA side specifically, we get paid by the bank, not by the client. So essentially, we work at no cost to the client. All that being said, we do require an exclusivity agreement that is basically to align us to be able to kind of go to battle alongside the client with the lenders, and then we collect a $2,500 good faith deposit that comes back after closing, or if we can't get the client approved. The rationale behind that, and I recently saw a slide from one of my competitors that's trying to use that to position themselves against us. The rationale behind that is, given the team that we kind of bring to battle or bring to bear when we're going to get financing for these lenders or for these clients from lenders, we don't want to be a position where, we're 7 to 8 weeks into the process and we find out the client has been running their own financing process behind our back, which unfortunately has happened a few times, most recently at the tail end of last year. And we're basically kind of left at the table with nothing to show for it. And so that, to date has never not gone back to the client, but it's just so they have some economic skin in the game.
Well, let me say on that point there. In the Twitter world, it's like the way that I do it is the best way, and it's the only way, and it's the right way. And it's like, no. There's different ways for different people. And if you're a buyer and you hear what Matthias has to offer, and you don't like that, there's other people out there. But also, if you want the team that Matthias brings to the table, this is his offer. And so it's like I get so tired online. People are like, oh well, this is a scam. This is fraudulent. It's like, no, it's free
Right.
market capitalism. You're putting an offer out there, and if people like it, great. And what I will say is, I'm not working with buyers currently, but working with buyers, I've come across a lot of buyers who aren't really serious. They like the title buyer, and they will waste a lot of your time by just saying, "Oh, I want to look at this. I want to look at this." And so,
Yeah.
so if you're trying to cull some of them out, I respect that, because there are people that I see on X who have been a buyer as long as I've known them, and they haven't bought anything, but they're always talking about
Right.
some deal they're looking at, and so.
There definitely are some of those people, and I guess that's kind of a longer conversation, maybe for a different time. But I remember back when I started going to the conferences, the search fund conferences, there were people I would see in 2022 that were still at the conferences in 2024. And I remember talking with a few of them, asking, have you submitted any LOIs? How are things going in the process? And to a degree, I think there are some people, I think it's probably a select small set of the search population as a whole, that want to be part of the community, but just either aren't sure if they want to go for it or whatever. But that's not a rub on anyone in particular. I think just something that can be cognizant of. So
Yeah, I'm not. Yeah, if you don't want to buy a business, I don't care. Don't buy a business. I'm just saying that when I was dealing with buyers, I come across a lot. They're like, "Send me anything. I'll look at anything." I was like, "Yeah, you're not. Just okay, cool, great. Anything means nothing." Well, the reason I want to get you on though is that you do work a lot with buyers, and so you see the buyer side perspective a lot on these deals. And what I advise owners a lot is to say, hey, owner, if you don't understand what the buyer wants, then you're really going to struggle to make them happy. You're really going to struggle to put forth a company that is going to bring you a premium buyer and be valuable. So what are some of the things that you're seeing that are, I don't want to say frustrating, but slowing deals down, things that owners could do to make the buyers happier?
yeah, so I guess would this could be before the sign LOI or just in general over the process of the deal?
Well, it could be both, because post LOI, you could be seeing stuff that they should have fixed, last year as
Yeah.
well.
Yeah. So I would say a couple things as a whole. So one is so speaking from the standpoint of like the broker listing. So generally, as you're probably acutely aware, Ryan, it's you sign the NDA first to get access to the broker listing or the SIM, the confidential information memorandum, and then there's kind of a sequence of events preceding the LOI. I would say to the degree that it's possible to really put tax figures in the SIM, even if they're not the tax returns, that just saves both parties so much time, because the vast majority of banks in the SBA system, and there may be a few outliers, underrate to the tax returns. And so if the tax returns are cash basis and the interims are accrual, and there's a huge variance between the two, at the end of the day, LOI gets papered and signed. you get the tax returns, and then bing, bang, boom, all of a sudden the numbers are completely different. And then you're basically stuck. So I would say, to the degree that's possible, to put high quality information early on in the initial materials the buyer's reviewing, that will make the buyer happier and really kind of set things on the right footing for the transaction as a whole, both from the lending standpoint, but also from just building trust and rapport. And like, kind of adjacent comment to that is, sometimes with things like the transition period, it's left as a TBD, or like something that's very short, kind of advertised in the broker listing. If you're coming to buy a business and you're not coming from the industry, you're coming from a job in corporate America, maybe working at Walmart, working at some investment bank, corporate marketing job, and you maybe have some leadership experience, but you're learning how to be a business owner alongside learning the industry as a whole, it really sets things up for failure if you're pinpointing, one, a short transition period, or two, that it's just not really offered. And one dynamic too that's especially critical for sellers, not to ramble too much here on, is if you're holding a seller's note, you have motivation for things to go well post transaction, because you're only going to ultimately get paid on those payments from the seller's note if the buyer can operate the company. And so I would say, as a seller, either a current seller or prospective seller, if you're watching this podcast, really thinking about what are your goals post transaction with the legacy of the business. And do you care most about just getting the biggest economic payout at closing? Or do you really want to kind of set things up for success, where you can look back 3 years, 5 years, 10 years post transaction and say, look, this business that I operated ultimately transitioned well to the buyer, and it's continuing to hum because I set it up well, due to giving high quality financial information so the buyer could do their diligence in conjunction with a proper transition agreement. I know I kind of threw a lot at you there, but
It's great because I think I stress this to owners all the time, is that, I made this example the other day on, I'll talk to someone, I'll tell you, is like, okay, hey, well, I won't go on all that. Anyways, in short, what you're saying is, there's a lot of things that they can do. So let's go back to cash versus accrual, because I think probably
yeah.
most people are doing accrual now. But let's say you're doing cash. Okay, it's like, how long do I got to switch over to accrual? Can I just make that change on paper, go back and update the books, or do I have to show a record of switching from cash to accrual for a period of time? Like, how long does that process take?
Yeah, that's a great question, to be honest with you, and one I haven't really been asked before. I would say so. I guess kind of first things first. So you want to make sure the way that you're recognizing income and expenses aligns with the type of business that you have. So, like, for example, let's say that you're a barber shop, right? Or like a restaurant. You're probably going to be on cash based financials, because you basically, at the point of time of sale, you're going to collect the income, and then the expenses side, kind of similar ish. But let's say you're a manufacturing company or a contracting business, and you sign a contract, and there's going to be a period of time between when the contract gets signed and when you get the revenue from the actual contract. Different businesses fall more naturally into different buckets as to what's appropriate. And so I think the first thing that you have to ask yourself as the business owner is, from the way that you're doing your accounting now, pre-sale, is the accounting method appropriate based on the type of business? And if it's not, and if you're not really sure, go back and ask your accountant. Now, as far as trying to change the accounting method shortly before the SBA financing process, I haven't really seen that come to bear before, candidly. Um, Generally speaking, what I would say I've seen is the lenders just kind of revert to the accounting method that's on the tax returns. And so if let's just say hypothetically, Ryan, I'm selling Matthias Distribution Company, you're the buyer, we're about to go under LOI. Whatever accounting method I have on my taxes is just what your lender is going to underwrite off of, basically.
It's okay. I always tell people on the show, like, if you don't know, it's fine, because I think that's so
Yeah.
important that owners feel like I know all this stuff, or I have to pretend like I know all this stuff, and this stuff is complicated. There's so many little
Right.
nuances and facets, and so it's okay to say, yeah, I'm not sure.
Right.
Talk to
Well,
someone who's.
there's one of the things too, just being a business owner, again, not to meander here from the whatever you have teed up to ask me, is like the best thing is to know what you're good at and what you're not good
Mm-hmm.
at.
Mm,
And to the degree that you can afford to have professionals helping you, whether it's on the accounting side, the legal side, or otherwise, at the end of the day, being an entrepreneur, presumably the highest and best use of your time is growing your business, helping to lead your team, and basically helping to grow the organization.
right.
And using Claude, Gemini, or ChatGPT to look into accrual versus cash accounting and things like that, that can get dangerous because sometimes AI can hallucinate and lead you in the wrong direction. So if you're ever not sure, just ask around within your community, try to find someone who's competent, and hopefully farm out whatever that work is to that person.
Yeah, I would say you can ask Claude, ChatGPT, or Gemini, but they will tell you the same thing I can tell you when an owner calls and says, "Hey, what about this thing in the contract?" Bro, I'll give you
Right,
my opinion, but if you get sued, you ain't calling me. Like,
right,
it'll give you an opinion,
right.
but you do talk to a legal expert. Okay, so you
Yeah,
talk about cash versus accrual, and just as a side note, Matthias, if an owner's listening to this, they go, "Yeah, I need some help on this process." Are you someone, if an owner comes to you before they have an LOI, before they've and said, "Okay, hey, I want
yeah,
my business to be sellable," can you go ahead and find the right bank? Because part of what you're doing, as you mentioned earlier, is you're finding the
yeah.
right bank for the deal. So if an owner without a buyer comes and is looking, would you help with that process as well?
Yeah, so I would give them like let's just say again to kind of role play here, Ryan. Let's say you came to me, you're looking to sell your business, and maybe you've run like a bunch of personal expenses through the financials. And like I kind of look at the financials and I'm like, okay, Ryan, you should probably go and amend your tax returns. You're gonna end up paying more taxes. I get it sucks, but you're gonna show the true cash flow of your company. And when a buyer goes to underwrite it, it's actually going to show that it's profitable. So like that's like to the extent that I would really be helpful, it would be kind of pointing things out like that. As far as finding the bank that would ultimately lend on their specific business, there are lots of different variables that would really impact that, and one of which is the structure the ultimate buyer is going to have that they're looking to use for the deal. And so like you could have a business doing $1 million of earnings, and based on like let's say you come to me before you have a deal under LOI, and there are five different buyers with five different structures. Each of those buyers with your same deal, there's a different bank. If you think about like different doors or like different paths you're going to go down, there could be five different banks that would finance that deal different ways, if that makes sense. So it all comes down to buyer plus deal plus structure. And then there's other factors too. Now, that being said, by process of elimination, based on things like the industry of the business, there are some banks that just would not finance the deal. So, like, if you look at things, so I guess kind of first and foremost, there are industries that the SBA just won't lend on. Anything that's marijuana related, gambling or prostitution, and then there are some other carve outs or like money services. But like e-commerce, some banks are kind of hot and cold on that. There's kind of longer conversation, things like Amazon disruption, supply chain, China, things of that nature. But then things that are kind of politically sensitive. So think about like gun ranges, right? Like just stuff like that. There's some banks that just have the philosophy they just don't want to touch specific things. But as far as like a deal in a desirable industry, if you have a good business, it's going to come down to what the debt service coverage is for the buyer based on their structure in conjunction with what does the debt and equity stack look like as far as the percent of financing from the SBA bank alongside the seller note relative to buyer and investor equity. If that makes sense.
No, it makes great sense, and it's a great reminder because just because Bank A says they won't finance the deal, you have to ask, is this an SBA rejection or a bank rejection, right? Because if it's
Right.
SBA, it don't matter where you go.
Right.
If it's that bank, a different bank might look at it and go, oh, okay, yeah, this it fits
Yeah.
within the SBA rules, and then you have to make sure, on top of that, that the bank you're dealing with actually understands the SBA rules, which is a whole other
Right.
ball of wax because plenty of them out there don't do
Yeah.
enough SBA deals to understand it.
And one thing there too, like I'd say a couple of things. So the self-serving comment would be, if you're a buyer looking at a deal and you get rejected from a bank and you're not sure why, feel free to email myself or my team. So either myself, Matthias, Matthias at pioneercap.com, or my head of business development, Raphael, Raphael, Rafael at pioneercap.com. And we could give you kind of our synopsis on if it's a bank lender credit policy thing versus SBA requirements. If you want to be more autonomous, you can go on Google and find the SBA SOP standard operating procedures, run those through ChatGPT with the rejection reason, and just see what it says. Now, the one thing I'll caution is there are documents called procedural notices, which essentially amend the SBA from how it was approved at that point in time. And so the way to kind of think about it is like when the SBA guidelines comes out, that's the new rule book. But then over time, there are addendums to that rule book. And sometimes ChatGPT doesn't know where to go to find those procedural notices. And so there can be little technical things that change it. So to give you an example, for anyone watching this, recently at the end of last year, the SBA removed the requirement for if you're doing an expansion acquisition and basically buying a company in the same industry with the same ownership group, it no longer has to be in the same geographic area. So before, say that Ryan has Ryan's distribution, wants to buy another distribution business, and let's just say you're in Houston, Texas. I can't remember specifically where you are. Um,
About four
if
hours
you want to,
away from there, but close enough. Close enough.
okay. So if you want to buy another one, it would have to be in the same relative geographic area. There was discretion there, and you would have to be the ownership would have to be the same. That entity that you're buying would have to be co-borrowers alongside with your current platform company. So that requirement went away last fall, but the current guidelines, the SBA SOP, that document didn't change. And so if you were a buyer running that document through AI, asking AI basically, is that geographic requirement applicable? It's not going to pick up on that because that got changed in the procedural notice.
Yeah, no, there's so much to the SBA process that if you're kind of coming from the outside trying to figure out what's going on, it can be overwhelming. Okay, so what are some other things that you've seen? You mentioned kind of some taxes. You mentioned maybe cash versus accrual. What are some other things that you've seen that owners have done? And I like to say unknowingly because a lot of times owners are doing things they don't know it's hurting their value, it's hurting the ability to get deals done. What are some other things
Yeah.
that you've seen them do that you're like, hey guys, if you just stop this, more of your deals would close?
Yeah. So I'll give one that's a little bit kind of off the fairway, if you will, and not one that people would necessarily think about. I would say one is to the degree that you're really the linchpin of driving the organization from like a revenue and business development standpoint, that kind of bites you in the ass when you go to sell. Because if you think about it, like if you're the buyer and you're looking at buying the company and you're like, okay, I lose Ryan, I'm screwed. All of a sudden, you're trying to figure out, okay, is there a number two person in the organization that can teach you the industry, teach you the know how, things like that? Because one thing, Ryan, is if you're buying all of a company, doing a complete acquisition with SBA financing, the seller cannot stay in the business for more than a year after closing. I don't know why specifically that guideline is applicable. I kind of have my own views on it, but that's a whole different conversation.
Say that again just to make sure everyone heard that right.
Yeah. If I buy your business and I'm a business buyer using SBA financing and I'm buying all of your company, you're not retaining any ownership. After 1 year from today, you have to be gone. And so
which is
back to
risky,
the
right? Which is
which
risky
is it's crazy.
if going back to your point, if you are everything, then
Yeah.
you have to be gone.
Right.
Then and listen, I've heard some banks say, well, we don't really, that's the rule. We don't really check in, but you don't know what
Right.
you don't know. You don't know what's going to happen. So if you're playing
Right.
safe, you don't want to get in trouble.
Yeah.
Then assume a
Right.
year you're out. And if you're a buyer, you
Right.
definitely want to play it safe. So
Yeah.
a year you're out.
So
Like it's a big deal.
yeah. So but what was the original question again? Sorry, I don't want to ramble too
Oh, no,
far
no, no.
from
Just
the
things that owners are doing
yeah.
that can hurt the deal. And you were talking about owner dependency and how that can
Right.
hurt the deal, and that this is why.
Yeah. So what you're probably doing as a seller that you're not thinking about is you're being too critically involved in the business. So if you have other people in the company that have potential that can, enable you to take a vacation, enable the business to operate more autonomously, you want to lead those people up to operate at their highest and best potential so that you basically have a company that can run without you. So this is actually kind of a very contemporary and interesting time to have this conversation because right now I'm currently out on paternity leave, and my chief operating officer is doing a phenomenal job at running the business. But going back to like May of 2022 is just me. And so it's like you go from being a one person organization to having a team. And so, kind of taking this full circle back to this conversation, if you're selling your company and you can't envision the buyer being able to run it without you because you have all the SOPs, everything in your head, you're screwed, honestly. You don't have a saleable business because they can look at the earnings and they can look at the financials, but you drove all of that basically, right?
Yeah, and
And
it's not even the SBA size deal. I talked to an owner one time. They're doing 30 million in rev, and he's like, "Well, if I go away, the company goes under." I'm like,
right,
well,
right,
who's going to pay for a $30 million business
right.
anything? Because
Yeah,
you're saying if you leave, and this was an older gentleman too, so like closer to death than birth. He's in his
right.
60s or 70s. It's like, brother,
Yeah.
you can't say that. And so I
So
don't.
there's
But well, go ahead. Yeah.
so there's kind of a solution back to that, which is so like back when the SBA guidelines changed last year, if you want to be able to stay on in the business for more than a year, so say again, Ryan, I'm buying your company, I'm coming from corporate America, I don't know your industry, and I look at the fact that you're such a critical part of the business that I want you to stay on for longer than a year, that's fine, but then you have to retain equity. Now, not only do you have to retain equity, if you're retaining below 20%, you have to personally guarantee my SBA loan for 2 years. So if I run your business into the ground and if the ship sinks, we're both going down the Titanic together. But if you believe in me as a buyer and you want economic upside during that period of time, maybe we become Siamese twins at the hip and work having the recourse together. So that's kind of like a bridge solution to this. Now, I have not candidly seen any deals get done with the seller doing the 2 year personal guarantee as far as I'm aware. I have heard that they have gotten done. I think Bruce Marks at First Bank of the Lake, shout out to Bruce, may have tweeted or posted about one getting done. But essentially, it's a huge risk, right? Because if we don't know each other, I'm coming in to have majority control and operate the company, and you're going to get, like economic upside if things go well and I buy out your equity at a higher valuation in a few years from now. But the question is like, how much probability do you allocate to that scenario if I've never run your business before?
Yeah. Well, you mentioned, and make sure we're getting the terms right. So you mentioned kind of owner financing, or having some skin in the game that way, and now we're talking about equity. What's a standard? Because and
Yeah.
I always stress this. I hate the hate that people do on people. So I'm not like anti Cody Sanchez. If you can buy a business for 100% owner financing, great. I just think owners can attract better buyers than that. So,
Yeah.
but so what is your general percentage that you're seeing of owner financing in these deals?
So the short answer is it very much depends. On the lower bound 0, which is more rare than common currently, banks have gone more conservative in the last year to 2 years, just due to the higher SBA default rates, and some other kind of factors too. I would say with deals that do have owner financing, 5% on the lower bound, up to 20%, sometimes more. The factors that impact how much owner financing there is either has to do with customer concentration and trying to mitigate or solve around that. So, like, let's say you have one customer that's 30% of sales, and you want the seller to have additional financial motivation to make sure that that transition from the seller to you goes well, especially if there's like close relationship that's not really arm's length between the seller and that customer. Maybe they're friends or something similar. um, I'd say that's kind of one of the reasons that can draw higher seller financing, of which typically it's forgivable in nature. And then sometimes the buyer, even if the seller doesn't seem very dependent in the business, the revenue and earnings is pretty diversified and similar, but they just want the seller to have some economic chips on the table post transaction. They want like a small sliver of seller financing, 5 to 10%, give or take. Um, I would say, generally speaking, you want to get the amortization as long as possible on the seller's note in like the 8 to 10 year range. And then most banks are typically fine if you have a balloon payment around like year 4 or year 5, give or take.
Well, and I love that you brought up customer concentration, because that's a drum I've been beating on here recently. Is that like, hey guys, you got to lower this because it is a risk, and so if you don't fix that, you are going to have higher owner financing. And so it's one of those things that if you position your business sooner, because you can't fix customer concentration overnight, right? You can't say, oh, we landed a new client, it's down to 10%, we're good. No, it takes time to unwind that. So, okay, I know you do have other things that you got to do, so I appreciate your time. So any final words here today before you hop out and go take care of that important business that you got? So
Yeah, I'd say the biggest thing, so like speaking to buyers specifically, so if you're planning to use SBA financing, there's kind of the specific rules that you have to follow to not end up in prison or on Sans Naughty lists. I would say try to make sure that you're not being too cute about how you structure deals where sellers notes converting to equity or things like that, and like side agreements, because at the end of the day too, like, it kind of shoots the program in the kneecaps. And anytime, like, all these government funding bills are annually, and that's when lawmakers in Washington have concern about funding the program, is just some of the outlier scenarios like that. But I would say one thing is really look at the broker listing and ask the right questions on the front end to determine how involved is the seller in the business. Do you need a long transition period? What is the requirement from a licensing standpoint? Are the licenses assumable if you do a stock deal? Who needs to be the qualifier? Things like that, trying to solve around that. And then I would say another thing too is looking at how big of a business you can afford based on your cash on hand and your post-close liquidity. So post-close liquidity being, if you look at your collective amount of cash, taxable stocks, and financial resources you could use to buy a business, and how much you're looking to use for the acquisition of that amount, how much you're going to have left over. And trying to make sure that you're being conservative from that standpoint, because if you have a mortgage to pay, if you have a spouse, if you have kids, if you have lots of high monthly expenses, daycare costs, or whatever, the whole amount of financial resources you have on hand now can't be used for the down payment. And banks are looking a lot more at that post-close liquidity bucket, not just your personal financial statement pre-acquisition. So I would recommend, if you want to buy a bigger business, let's say a $5 million company, and you have $150,000, you want to be having conversations to meet potential investors pre-LOI, because once you're under LOI, all of a sudden it's go time. and then the bank is going to start hammering you with questions to ask, you know, where's the other money coming from for the down payment? And so, not to ramble too much, but happy to have conversations with anyone and everyone. Feel free to either shoot me an email to Matthias@pioneercap.com or email my head of business development, Rafael Lopez at Rafael@pioneercap.com. So
Matthias, it's
thanks for
always
having me on,
great.
man.
Yeah, it's always great to hear from you, learn from you. You guys are crushing it over there, and congrats on the new baby. So we'll talk soon, brother.
Appreciate it.